All right, guys. So today Joey and I had a conversation off camera that was so good. I thought we really should bring it on camera and talk about it with you guys. So he told me he helped his mom pay off her 30-year mortgage in 8 years using a method called velocity banking. So we're just going to get right into it. Joey, what is velocity banking, my man?
Yo, welcome to Uncommon Estate of Mind, where we debate different ways to leverage your next investment to create time freedom, legacy impact, and generational wealth. In order to live that uncommon life, but to do that, you must be uncommon. My name is Joey, aka Mr. J Mays.
Hey, it's your boy AD, also known as AD the Fly Realtor.
Yep.
All right, guys. So today Joey and I had a conversation off camera that was so good. I thought we really should bring it on camera and talk about it with you guys. So he told me he helped his mom pay off her 30-year mortgage in 8 years using a method called velocity banking. So we're just going to get right into it. Joey, what is velocity banking, my man?
Well, look. As much as I want to hop into it, I need to ask, as we always do, it's ritual. How's your day going, brother?
Man, and like you know, my days always go well. All my days are just degrees of good, but but I don't know what it is. Like, I've been having a really good day. Like, I don't think it's because it's the weekend, because like, I kind of do the same thing every day.
Yeah.
So I don't know what it is, or maybe I'm just excited to shoot, that it's fun doing this, so, but how are you doing?
Bro, I am good. I'm really good, especially since we're about to talk about how I was able to pay off my mom's 30-year mortgage.
Yes. Trust me, guys, he is excited about this, like, really.
30-year mortgage in 8 years. Yo, like, to be honest, like, come on, yo, like, to do something for moms, you know what I'm saying? I'm trying to retire moms early, you know what I mean? And this is one of the ways to do that, to get that house payment out the way. You know what I'm saying? That's just another asset that she has that she can just dip into whenever she wants to, right?
Right.
So, okay. So to be honest with you, I really want to get into the details of how I did this.
Okay, please do.
But I can't.
Right, here we go.
I can't, because the first thing I need you, in order for you to like fully understand like the gravity of this, you first need to understand the difference between simple interest and compound interest. Okay, bro. So let's say I get into this investment, right? And it's, I put $1,000 into this investment.
Okay.
And they're guaranteeing me year after year, 10% interest on that simple interest.
Okay.
So first year rolls by. Okay. 10% interest on $1,000 is $100.
Right.
Okay. So next year I'm going to get another 10%. It's going to be based still on my principal amount that I put in, which is $1,000, even though I made $100 extra dollars.
Right.
So it's going to continue to be based on my principal amount that I have in that account, right? So say year 2 comes by, I make another $100. So now instead of 1,100, I have 12. Year 3 comes by, I have 1,300, so on and so forth.
Okay.
Right? And that's pretty much how simple interest works.
Okay, I got you. All right, so now explain for us how compound interest works.
Okay. So compounded interest, we'll use the same example. You know what I'm saying? I have this $1,000 investment that I'm in. I'm making 10% on my investment. Now, that first year, everything's going to stay the same.
Right.
Okay. That 10%, I'm going to make $100, and it's going to be $1,100 that I made after that first year. But now, instead of just getting interest off of the 1,000, you add in the interest from the first year, and now I'm making interest off of $1,100 instead of the 1,000.
Okay. All right. I hear you.
So that adds up over time, bro.
Right.
That's where they get the compounding benefit from it, bro. And that, like, to make compounded interest is like, you can't beat it.
Okay, cool. All right, so I guess we have a better idea of the differences right now between simple and compound interest. But please, for the sake of our audience, try and give us an example of like where we see simple interest in day-to-day life.
Okay, well, before I do that, because there's something I didn't do that I did want to bring up. So let's say that same investment that we were in, right? We both put in 1,000. I'm making simple interest. You're making compounded interest. After 5 years of payments, and I actually have it written down, 5 years of payments, if you're making compounded interest, you're going to have $1,690.51. Right? Off of that investment. Me, on the other hand, since I did simple, I'm only going to have $1,500. And that's it. You know what I'm saying?
Yeah.
So over time now, I want you guys to really think about this. Like, we're using small numbers. We're using by the 1,000. But once you get into more astronomical numbers, once you get into the hundreds of thousands, even tens of thousands, this becomes insane. Different.
It really does. It really does.
It's like imagine you and your friend are about to go off for a race. You run a 4.3 and your friend runs a 5 flat.
Right. Like in the first 10 yards, you guys might be around the same level, but once we hit that 40 and then 50, 60 yards, we're going to start seeing who's got burners and who doesn't.
Bro, I'm be Usain Bolt. Yeah. He would be Usain Bolt in this example.
We're seeing, because it really, like he said, it'll go in different directions very fast.
Yeah, big time. But yeah, but to answer your second question, bro, the most common place where we see simple interest, we're not making it. We're usually paying.
Right.
You know what I'm saying? Like, so for instance, a credit card, so I go get a pizza, $20 pizza, and my credit card interest is 10%, right? So off of that $20 pizza, $2 out of that pizza is going to go towards interest, right?
Right.
And that's simple interest for the most part.
You know? Okay. All right. I got you. All right. So that lays the foundation for simple interest. Are there examples you can give us for compound interest?
Okay. So this is where we get to the fun part.
Right.
Why? Because where do most people, once again, we're paying it though. We are paying it. But the most common place where you see compounded interest is in when you go buy a property. That 30-year mortgage or 15-year mortgage or whatever mortgage you have, that's where you see that compounded interest in play. Now, when you go buy a property, they don't call it compounded interest. They call it amortized, your amortization schedule, right? So another thing, when we're talking, we're talking about making money. So we're starting from the ground. We're starting from 1,000, and we don't have a ceiling of how much money we make. As long as we keep our money in that investment, the sky's the limit.
Right.
To how the compounded interest. When you go into property though, it's capped at whatever the property's worth. Okay. So say if it's it's a $500,000 property or whatever, $500,000 property, your amortized interest is capped. So what they're going to do, what the mortgage company is going to do is your first few years, you're going to be paying the highest amount of interest for, I want to say 10 to 15 years, bro.
Right. Yeah.
Before it starts to even out.
Yeah. Quick, let's touch on that very quickly. So for the standard loan, definitely any regular consumer loan, as far as for real estate, what Joey's trying to explain is that early on in that loan period, you're paying back that interest first, because like you mentioned, that what they're charging for is capped. So you're capped at what you took out a loan for, but you're not just paying back that principal. So you took out the loan for $500,000. You're not only paying $500,000, you're paying that interest. But what they're going to do is they're going to get that interest first. Boom. And they'll let you pay that principal after they get that interest money back.
So we could just keep on going back and forth on this. But so for instance, say you have a $16,000, because the thing is, your mortgage payment isn't going to change. It's going to be a set mortgage payment, right? What changes is where that money is divvied out, right? So initially, say you have a $16,000 mortgage payment. I would want to say let's say $16,000, $400 goes to your actual principal. That the rest, the $1,200, the large amount of money that you just paid, that $1,200 is going to go towards interest.
Oh, you mean $1,600?
What do you mean?
$1,600.
Yeah, so that's what I said. So they're paying $1,600. $400 of that is going towards their principal.
Right.
The rest of that $1,200 is going to their interest.
Okay, right.
Yeah. So you're sitting there like, damn, that's that's it's a scam.
Man, let me tell you something. They're gonna get their money hand over fist.
Bro, you gave me a bomb ass definition that you told me. Like, what does amortized mean again?
Like the actual meaning, like if you look up the root meaning of amortize, it derives from a word that means to kill or to death, meaning like you will pay for this.
Yeah,
It's your life.
So if you look up the meaning of amortized, pretty much it means death pledge, right? So they want you to pay this for the rest of your life.
Right.
And we're not having that. But yeah, that's pretty much what amortized or compound interest, that's where you see it the most in just everyday life.
All right, cool. So now that we got entry-level understanding of simple and compound interest, will you please tell us what is velocity banking?
Okay. So story time.
All right.
Because I learned velocity banking from my first real estate group that I got a part of, bro. I was sitting there at a real estate meeting, and this is how they hook you to be a part of their group. And when I heard it, it worked. So they're like, man, so this is a velocity banking pretty much is a strategy used by investors to accelerate the pay down of a debt. Also, if that debt includes interest, cut the amount of interest you pay, during the lifetime of that debt. Right.
I mean, that sounds cool. That really does and everything. But
yeah.
So I want to know, how exactly does velocity banking save you like money on your interest?
Okay. So back to the story. So like I was sitting there and, I found this bandit sign there, like learn how to be an investor today. And I went to one of their meetings and they showed me on paper, like how they were able to use, credit cards to pay down a 30-year mortgage. You know what I mean? With a credit card of a limit of around like 5 to 10K, right? So when I started doing this, of course, bro, so I saw this. I'm like, Mom, drop what you're doing. I'm like, drop what you're doing. Take a pencil out. Like, look what we finna do. So I went to my mom's, man, and I told her, like, look, like, so first off, my mom has decent credit, right? So with that, we were able to apply for, a decent credit card. I think it was like, I don't know, MasterCard or something like that, right? And she got approved for an $8,000 credit card. And with that $8,000 credit card, what we were able to do was take chunk payments or make chunk payments to the mortgage using that credit card. We never went over the 5K mark. We always stayed around 5K to go ahead and put a chunk payment towards the mortgage, as she's also making the regular mortgage payments to the house. Now, I'm going to ask you a question. How much more money do you think my mom had to make in order to put this strategy at play?
I don't know how much.
She pretty much didn't have to do anything extra, bro.
Okay.
She didn't have to go work any more extra hours. You know what I'm saying? She didn't have to pick up any extra shifts. She didn't have to do any of that.
Right. Okay.
Which was extremely important to me, because then it makes even more sense.
Right. And you know what's interesting, what this sounds like to me is something that a lot of savvy real estate investors do with a HELOC. You know what I mean? So it's pretty much the same principle where you, make chunk payments towards this debt.
Yeah.
And your payback is lower than if you had just paid the regular payments.
Right.
You know what I mean? And so you end up saving yourself money in the long term, because what you pay back on a HELOC is typically going to be a lot lower than what you pay when you're paying for interest on a standard mortgage.
And do you know why that is? Because on the HELOC, he's paying simple interest.
There we go. We circle back.
So are you okay? So on a HELOC, same thing with the credit cards, we're paying back simple interest. Whereas with the mortgage, you're taking down chunks of amortized interest. So for instance, say I get this credit card and the credit card is, whatever it is with interest. You know what I'm saying? Maybe it's like a 20% interest credit card, right? And you decide to use this 20% interest credit card to pay down that debt. Now, the debt that you're taking away is amortized. They say it's like a 6% interest it's 6% interest on the house, right? But that interest is amortized. It's compounded. For other words, compounded. So as I said before, that $1,600 payment, $400 is going to go to the principal. $1,200 is going to go to the interest. You know what I'm saying? Because they add all of your compounded interest and you're taking that down month by month. The highest amount of interest you're paying, you're going to pay at the beginning of your payments, of your amortization schedule of your for your mortgage, right? So now, the hack is this. Now, my mom and I take this $5K.
Okay.
And we say, we make a payment, and we're like, okay, we make sure to put down in the statement, well, before we, in the statement, like, this is a principal only payment. All right. That $5K goes to the mortgage company. That $5K amount knocked out 3 months of interest payments. Okay. So that's what, $1,200 times 3. Well, I don't even know what that is. That's
$36.
That's $3,600. Mm-hmm. That's $3,600 knocked out of interest payments from that $5K principal only payment.
But see, the thing is, some of you might hear that and be like, well, I pay $5,000 to save $3,600. What's going on here? The thing is that $5,000 is going to be something you were going to pay anyways because it went to the principal. So even if you weren't paying it right now, through the life of that loan, you were eventually going to pay it. So what this method here that Joey's laying out for you, what it did was save his mom from the burden of paying that $3,600. You know what I'm saying? So
another better example, because since I did this with a credit card, that's paying simple interest. To be honest, the credit card that we got, it was less than 20%, but I'm going to use 20% anyways, just to show you, even with a larger interest rate, it still makes sense. So $3,600 I saved from the mortgage payment.
Right.
I have I owe 20% off of the $5,000 that I just paid. What's 20% of $5,000?
That'll be $1,000.
$1,000 of interest compared to $3,600. $1,000 for 1 month. Okay? $3,600 of interest I just cut off of that mortgage. I also not only cutting off those interest payments, but I also have lessened the time it's gonna take for me to pay off this entire house, since the payments are going straight to the principal. So after some time, like I said, this is how you're able to cut a 30-year mortgage into 8 years, depending. Well, this is how I did it. You know what I'm saying? Now, everybody's situation is different of like how much they could afford and what they can, what they're able to bear. But this is how we were able to knock this out. If you don't believe me, guys, do your own research. First of all, another thing, I am not a financial consultant or any of that.
No,
so please
go ahead and toss in the legal disclaimer. Like, look, consult your lawyer, consult your auntie, but don't come back to us.
No. So what, if anything, go to Google or whatever you want, because you need to do your own due diligence. I wouldn't want you to take my word for it alone anyways. Go look up velocity banking. Then go look up the difference between principal interest and compound interest. YouTube is a beautiful source, guys. Go check it out. But yeah, that's pretty much the gist of it, bro. Like,
all right. Honestly, I'm here with you. Like it sounds comparable to a HELOC, so I'm understanding. So I'm getting it. I am getting it. But really, dude, this sounds too good to be true. So I just got to know, and like I'm sure the audience wants to know too, there's got to be some drawbacks to this velocity banking. So please, like, run us through what are some of the negatives or some of the drawbacks to velocity banking?
Okay, so one is if you have a really high interest payment on the card that you can't afford. Because either way, it's going to be less than what you pay for the house. But if you can't afford the interest payment on the card, well, then you need to wait till you can make more money so that you can go ahead and make that payment. Two, but there's a way around that, to be honest with you. Because people think of like credit card payments as like them losing money. No, a credit card payment is pretty much you shifting money from one place to another. You're pretty much just shifting money from one place to another. Why? Because after you make that payment to the card, you can use it right away. If you just transfer that cash that she made, like say she makes $5K and she put $3K into the card and she did it 5 days prior to the bill being due, she's not paying interest on it. Okay? She's not paying interest on the card at all. So when you look at it that way, like it's just a money transfer. Now, it's not like you're going to be able to do this every month. And this is why she didn't have to go get an extra job. This is why she didn't have to make any extra money. As she continued to get paid, like let's say her threshold was maybe she could only pay like $500 back to that card each month. So $500 to that $5,000 debt. And the thing is, she's paying it ahead of time so she doesn't have to pay interest on it. So how long would $500 recoup to that?
So that'll be in 10 months.
So 10 months. In 10 months, she has another $5K ready to go and put another chunk payment directly to the principal, cutting down again 3 months. 3 months of interest payments, another $3,600 that she no longer has to pay.
I think you guys can get the gist of what he's trying to say.
Look, you know what I'm saying? So you're cutting down the time, since you're not making those interest payments, you're cutting down the time that you're going to be paying back this mortgage, guys. And it's so powerful. This is what real estate investors use in order to take down most. There's several different tools in the toolbox, but this is definitely one of them. Okay.
Yeah. And you know what? It definitely makes a lot of sense there's some of us out there who maybe you're not too down for the idea of having debt. Like you don't think maybe you could be a big time real estate investor or you can acquire a lot of debt because it'll interrupt your sleep at night. You know, that's not for everybody. Perhaps velocity banking could be a method for you to implement in your investing journey so that you can get a property and pay it off a little quicker instead of having a 30-year or however many year mortgage looming over you. You know, because like I said, some of us, we're okay with debt. We get how it works. Others, they may get how it works, but it just causes them to be uneasy. So this is just another option and strategy for you. That's one thing that, from what I'm hearing from Joey, makes velocity banking does sound like a very viable option for some of us out there.
Oh, like to be honest with you, if you don't want to go and tackle like a large expense right away, as a matter of fact, the best way to get started with velocity banking, maybe you don't want to go and tackle it with, your house payment. Maybe you want to start small. Okay. You can start velocity banking, maybe your credit cards that are over leveraged right now. You take the cash that you make the liquid cash that you make from work, you put it into a credit card, you start paying off minimal debts. As a matter of fact, I'm doing that with some family right now, where I'm helping my sister pay off a car loan using the velocity banking technique. And after that, we're going to start applying it to other things as we move forward, eventually real estate. But start with something small. Maybe you need to pay off a car that you just bought not too long ago. You know what I mean? And the best strategy, guys, is if your credit needs to be decent. That way you can qualify for low interest credit card. You want to actually try your best to apply for cards that are between 6, 9, 12, 18 months, 0 interest. Okay. The longer period you have not paying any interest to the card, the better. You know what I'm saying? Because then you really don't have to worry about the 5 days. But even if you did, you still can find a way not to pay interest.
Right.
So like, it is so powerful, guys. And I'm just happy that I could kind of discuss and talk about this. Obviously, I'm like,
No, really, I'm glad we talked about it too, because I think a lot of us beginners out here, we really need to know that it's not a one size fits all. You know what I mean? There's strategies that will work for you that may not work for me. There's strategies that don't work for you that do work for me. You know what I mean? Like, there's so many strategies out here, but a lot of times, if we're unaware of those strategies, we think we're, pigeonholed or stuck to whatever one strategy some random dude knows or whatever strategy your family member knows. Whereas, like, no, there's a lot of strategies out there that are more conducive to you, your personality, and characteristic traits. So I do have one more question for you, though. All right, so how does one of our beginning investors, how would they know if velocity banking is something that would work for them?
Okay, so the first way to see if velocity banking is for you is do you have credit cards that can handle a large chunk payment without you over leveraging the credit, without you having to completely wipe out the balance on that credit card or use the entirety of the funds available on that credit card.
So about how much space will we be looking for?
I would want, minimum to start, I want at least $8K because I would want to do at least $5K chunk payments. But if you wanted to start, say you had a $5K credit card, fine. You'll just be making $3,000 payments. You just want to make sure you have, I would keep at least $2,000 on that. Me personally, you know what I'm saying? I would keep at least $2,000 on that card. Now, let me explain this to you. So that way we covered all bases. Understand that credit is a tool, okay? Credit is a tool to be used. So say you have great credit, you go apply for these credit cards, you get a line that's around 5K, and a line that's about 8K, and you plan on using 5K. As I said in previous episodes, you'll leverage that card. If you're taking 5K out of it, you're gonna leverage that card over that 30% threshold. So there's a good chance that your credit score may go down. Now, once again, you have to decide in this arena, like, okay, I know that credit is a tool to be used. I know that this card is a tool to be used. So which one do I not mind leveraging for a little bit? Because the second that you put all those payments back on that card, say it takes you 10 months at that $500 a month, 10 months, all of that cash is back, you'll reach that 30% threshold again before 10 months and your credit score will go right back up. You know what I'm saying? If you're that worried about credit and you have something else to do. But if this is your main goal, this is the main goal that you have for your credit, leverage that card. Don't worry about your credit fluctuating because it's going to go back up the second you pay those cards off. So that's one. Two, if you don't want your credit to fluctuate, you know what I'm saying, then hopefully you qualify for cards that are over that 5K mark. Say you get a 15K, maybe a 20K credit card. Well, then you have a lot of room to play with. And you can take 5K, put a chunk payment towards your mortgage, and you'll still be under that 30% threshold before banks start to mess with your credit score. You know what I'm saying? So and on top of that, this is a great way. This specific strategy is an awesome way to build credit. Like, your credit score goes, well, I'm going to use me. My credit score went through the roof. My mom's credit score went through the roof because since we were taking her normal income and we were just transitioning the money towards those credit cards over the limit or over the minimum balance, credit card companies are like, oh snaps, like every month they're making, they're exceeding the level of the minimum balance every month. And it's a high amount that they're paying back every time they put money back into this card. So credit card companies are like, oh, this person is trustworthy.
Right.
Your credit score starts to build. At least my credit score started to build. My mom's credit score went up through the roof. And on top of that, guess what you can do after banks see that money is being replenished? You can ask for higher lines of credit.
Right. And another thing I thought about while you were talking, you mentioned try to find cards that have maybe 6, 9, 12, or even 18 months of interest-free payments. So let's say you get that first credit card and then you eventually pay that off. Well, one, you were able to submit that chunk payment towards your principal on that debt, whether it's a property or a car or whatever it may be. But then also you just boosted your own credit score by paying back that credit card. So then now you also have a scenario in which you paid off that credit card. You may have exhausted that period of no interest payments, but you can go apply for another credit card. And perhaps you repeat the method.
Repeat. So that's even, and I'm so happy that you brought that up because that's exactly what you can do. The second that you pay off that card and you reach that limit, like we said, using the example that I said with my mom, she paid more off, but let's use that $500 example. It took 10 months to go ahead and pay all that entire card back. It took 10 months to go ahead and pay that entire card back, right? So let's say you had a 12-month interest-free payment. You paid it back in 10 months. So option one, you can go ask for a line increase. Option two, since your credit score boosted because you've been paying off that debt consistently, you can then go apply for another zero interest card, another 10, 12, 15, whatever months, forever.
Repeat.
You know what I'm saying? You could also, and another thing that credit card companies do, after you've shown good payment history, you can also ask to extend that zero interest period.
Right. True. Yeah, so many hats and so many opportunities out there, man. Like, I feel like for me, it just goes back to like what we always say, which is why it's so imperative to go out there and get more education and go see what those who may have more experience or who are more savvy than you are doing. Because it doesn't even mean that anybody's better than you. It just means they may have access to this information that you never knew about. So, and it really just brings me back to another reason why we're doing this show, because we want to try and get out as much information as possible, stuff that we know, and then even stuff that we don't know yet.
Yeah.
You know what I mean? So it's like, don't be afraid to just learn and go like capture all the info you can to better the life of yourself and also your family.
So I'm going to give you two sources really quickly. One of them I'm an affiliate of because I've used this product so much. I've acquired so much personal credit and business credit from this company that I was like, you know what, I'm going to go ahead and be an affiliate, because if the only reason I decided to be an affiliate is because I personally have used it and I have personally gained so much capital to go and invest, you know what I'm saying? And that is Fund and Grow. Fund and Grow is a company that helps you secure multiple lines of credit that you can go and pretty much implement this strategy with. They can first get you high personal lines, which builds relationships with these banks. And then after that, they go ahead and apply for business lines of credit, right? Now, the link is going to be at the bottom. Tap it if you're interested, guys. You do need good credit. But the thing is, what's awesome about Fund and Grow is after you have a conversation with them, they're going to be able to do a soft pull, tell you exactly where you are. They're like, oh yeah, you're good to go. Like, we can get you funded. We can start the funding process now. Or they'll look at your credit and be like, okay, like, we don't want to start it now because you're not going to get approved for much. So let's go ahead and, go get credit repair and let's repair these specific items in your credit. That way you could be approved for more. Now, they also have a credit partner, which is called Kadem Credit Help, which they usually have people partner with, you know what I mean? Because they're directly partnered with Fund and Grow. They help you take items off of your personal credit. That way, your credit score boosts and the negative items that will stop you from getting credit will be eliminated. Then Fund and Grow takes over from there and they start applying for these lines of credit for you. And to be honest, personally, I've had hundreds of thousands of dollars. Yeah. Not only me. So not only was I able to help my mom pay down her mortgage, but then I got my mom funded.
Right.
With Fund and Grow. And it was dope, and it was It's dope. It's a gift that keeps on giving. I have all of my business partners on it as well. It's awesome, guys. So check the link down below. Click the link, watch the video. If this is for you, if this is the area in your life that you're ready for, this is the business you need to be introduced to. The second source that I wanted to provide for you guys is a company called Plastique. Now, I'm not an affiliate of this company at all, but I have used them in order to pay off, to pay mortgages, right? Because, as you know, you can't just take a straight credit card and go pay a mortgage. You know what I mean? They usually want cash. Plastique, which I'll also have a link in the show notes for, you pay that company, right, with your credit card. That company then writes a check on your behalf and sends it to your mortgage company, right? So they turn the cash that you had with that credit card. Of course, they're also going to have an interest charge with it. But I guarantee you the interest that you pay from Plastique and the interest that you pay for the card combined isn't going to be more than the interest that you're knocking off of that mortgage payment. Anyways, so with that being said, you can use them to go ahead and write a check to your mortgage company to go ahead and make principal payments only to your mortgage. So there will be a link in the description in our show notes. Go ahead and check them out when you get a chance, okay?
Go ahead and check in the notes at the end of the show, and you'll see a link to Joey. You'll see Joey's affiliate link to Fund and Grow. I think that could definitely be advantageous for some of you out there, especially depending on what your situation is. And also, please remember to like, comment, and subscribe this show, and also share. Help us get the word out, because we're really trying to reach as many people as possible, and we want to help as many of you beginning investors as possible. So again, like, comment, and share. Let us know what strategies you like, you dislike, what you have implemented or you would like to implement. We want to hear. Let us know.
Yeah. And to be honest, I got our B for the day, and that's be creative. Okay. There's so many different ways and so many different tools out there to help you conquer debt, to help you realize that you have so much more financial freedom than the world will lead you to believe. If you're willing to go out and learn these creative strategies, but more importantly, implement them, you're taking your life and your family's life to the next level. All right.
Hey, and we're all trying to get to that next level. So you heard the man. Be creative, be you, and be uncommon.
Oh.
Till next time.